Before we begin, just a small announcement. You can see on the calendar here, we're at July 30th. Let's jump all the way to September. I am out of the country from Monday, September 4th, all the way to Tuesday, September 19th. So there'll be no market update on September 10th, Sunday, September 10th, and Sunday, September 17th. I'm not sure what kind of internet connection I'm going to have from the hotel that I'm in. I have requested hotels with high-speed internet, so I don't know if that's what got booked for me. But if we do have high-speed internet at those hotels, maybe I'll do a live stream on the 10th and on the 17th. I could probably do a live stream. The 10th I'll be in, I think I'm still in Costa Rica on the 10th, and I'm in Panama on the 17th. So I'll try to do a live stream. If it's good internet connection during the course of the week, I'll put up a notice. I'll just schedule it on YouTube, and if you're subscribed to my channel, you'll get a notice. I'll have a live stream. So I'll do a live stream as opposed to a prepared video if I can. But if I can't, then for those 2 weeks, there'll be nothing. I think I'll still be able to get something up for the 3rd because I don't leave till the 4th. For the applied series, the next video was uploaded on Friday. It showed a very basic income strategy, a very low-risk income strategy. The next video in that series will be up this Friday. There'll be one every Friday until I feel we're done. I think that's somewhere 5-6 months from now. For understanding banks, I got the credit risk one done, asset quality, credit risk, it's the same thing, late on Friday. So it will be up sometime Monday during the day. And then next week is the last entry in that one for capital adequacy. Now that the new discussion paper, the discussion paper for the new capital requirements has been put out. It's only a discussion paper. We can do capital adequacy in light of the probable changes that are going to happen in the U.S. in terms of capital adequacy. And if you are part of the applied series, remember today, it's the last Sunday of the month, the last Sunday of every month. I do live streams for just the applied series candidates, so you have to log into the site to access that. The first one's at noon. The second one, I believe, is at 9 p.m. this evening. Okay, let's go. Last week, we noted that money market rates were making room for a 25 basis point rate hike. We got the 25 basis point rate hike, and week over week, very little changed in the money market rates. Pretty much right where it ended last week. And I think going forward, money market rates will probably display very low volatility. Capital market rates did increase at the long end of the curve. I think higher for longer is starting to set in. Good economic data last week, and viewing the economic data coming out, it's hard to envision a rate cut with this type of data coming out. So we did have some increases at the long end of the curve. I think if there's volatility, it's probably going to be at the long end. Still have our curve inversions, 389 days on the 2 to the 10 year, 276 days on the 3 month to the 10 year. The forward curve is pricing in with over the next 18 months, 167 basis points of cuts, almost 7 rate cuts. Canadian curve also still quite inverted. Balance sheet runoff continues, another almost 23 billion, down to 7.493 trillion. The balance sheet went from 8.243 to 8.274, a drop of 31.2 billion. So there was a net drop of 8.4 billion outside of the SOMA. Just to give you some context of how high this number is, the 7.4 trillion, that there's still a lot of liquidity out there. Prior to 2008, the balance sheet was under $1 trillion, around $800 billion. 2014 to 2020 ranged anywhere from 4 to 4.5 trillion. So just to get back to pre-pandemic levels, 2015, 2016, 2017 levels, you've still got another $3 trillion to go. And at the pace of runoff now, that's another 3 years. And this was considered a high level for the balance sheet. A lot of liquidity still in the system. So as far as liquidity in the system, even though the balance sheet is coming down, there is a lot out there. I think they could speed up the runoff of the balance sheet. And they did say last year at some point it may become appropriate to start selling MBS to reduce the balance sheet, but they haven't gotten there yet. And if they do that, that will be well telegraphed in advance. Money market funds continue to increase, almost by 30 billion here. Retail increased by 4 billion, both for government and for prime. Institution increased by 24.3 billion. The big surprise here, government money market funds up 25.7 billion. Prime is down 1.23. It could be month end. It could be money moving around for month end. Next FOMC meeting in September, 52 days away. 80% probability that nothing is going to happen. Last week was 83. 80% that nothing will happen. Minutes, we get in 17 days, and the July jobs report we get in 5 days. If we go to the end of December, the last meeting of the year, week over week, the probabilities moved around a little bit, but on net, basically unchanged. Effective federal funds rate is now 5.33, and the reverse repo continues to decline, down another 40 billion, down to 1.73 trillion. And our lags, we've had a 25 basis point increase, so the lags and the effect have changed a bit. Well, not the lags, but the effect has changed a bit. So if we'll just draw a line here and we'll cut it off here. There's a 12-month lag. There's a 24-month lag. So if we accept a 12-month lag, that means there's 375 basis points of effect that has yet to be felt. Fed has raised 525 basis points. That means 250 has been felt, and there is some thinking inside the Fed that the neutral rate is around 2.5%. And if that's the case, monetary policy has gone from very accommodative to neutral over the last year. If we believe the lags, if we accept that it works with a lag and we take a 12-month lag, that means that monetary policy has not even become restrictive yet. It's gone from accommodative to neutral. And as I said on the previous screen, when we looked at the level of the balance sheet, there is still a whole lot of liquidity out there. So it could be that the stance of the central bank at this point in time, in terms of the effect that has been felt in the economy, yes, you have dwindled down the balance sheet by about $1 trillion, but it's still a good $3 trillion over what was considered ample liquidity. And if we accept that the interest rate works with a lag, then most of the interest rate increases haven't even been felt yet. We've simply gone from accommodative to neutral. And if we accept that, then it's sort of, when we look at the economy, we look at the jobs market, when we look at GDP, when we look at certain economic indicators, showing a strong and resilient economy, it could be that, well, that's because we haven't even hit restrictive monetary territory yet. If we accept that 12-month lag, we have simply just moved to the neutral rate with ample liquidity in the system. It'll be another 3 years before we get to a point where there's a lot of liquidity, from ample liquidity to a lot of liquidity. And if we keep rolling off at $1 trillion a year, you're probably 5 to 6 years before you get back to where you were before the financial crisis. So there's still a lot of liquidity in the system. And if we accept the lags, we haven't even hit restrictive policy yet. Last week I had said that it's probably time for inflation and the central bank to move to the back seat. We're not kicking them out of the car, but moving them to the back seat, and labor or jobs data should be in the front seat. So we'll spend more time on that each week. Last week we got the employment cost index, and this week we have a whole bunch of labor data coming out. Tuesday, Wednesday, Thursday, Friday. Tuesday is JOLTS. Wednesday is the always wrong ADP. Thursday, initial claims, continuing claims, and for Q2, we'll get measures for non-farm productivity and unit labor costs. There's been a problem with productivity being negative for some time. The previous reading was negative 2.1. Negative productivity raises unit labor costs, so the previous reading there was 4.2. The forecast here is for positive productivity, 2%. Going from negative productivity to positive, which it hasn't done that for, I think, 5 quarters now. Positive, and a drop in unit labor costs, which, if you're going to have a drop in unit labor costs, either you're paying people less or you have higher productivity. Well, we're not paying people less. So to get a drop, you're going to need higher productivity. And then Friday, the jobs report forecast is for 175,000. Let's have a look at ECI for June 23, 1%. Annualized, that's 4.06%. If we look at year over year, 12-month trailing, 4.5%. Last quarter annualized was 4.8%. Looking forward, 4.8% annualized, now 4.06% annualized. But we do have unions that are just rolling over companies right now. Teamsters did a really good number on UPS, 30% wage increase over 5 years. And you have the auto companies that are up next, GM, Stellantis, and Ford. And there is some tough talk going on there. The contracts end in September, so contract talks are going to start, I think, this week. So let's see what they get. This is really interesting here. If we look at the constant dollar, look at June 2022, negative real earnings, and March 2023, negative to flat real earnings. Now they're all positive. And here is a chart that's given in the ECI as well. 12-month percentage change, constant dollar. There is positive real earnings, there is negative real earnings, and now it is positive again, given the propensity to consume, the marginal propensity to consume being so high with the American population. Now that you have real wage gains, that means for a given paycheck, the individual can just simply buy more stuff now than they did last quarter for the same paycheck. Real rates inching back up last week. Still have an inversion from the 5 to the 10 of 32 basis points, and very little change on the break-even rates. Same with Fed funds futures. Very little change here. November, December. Sitting implied rates right around 5.4, pretty much where you were last week. Slight increase week over week. Going out to March, 5.28. Week before was 5.23, so an increase of 5. And then going out to June, implied rate 4.98. It was 4.865, an increase of 11.5. So we've basically went from this last week downwards. And I think if the data continues to come out strong, this is what's going to happen to the curve, which means this is probably not realistic. 2024 implying the market's implying rate cuts, 4 to 5 rate cuts for next year. And if you have this kind of data that continues, you have earnings that continue in the 220 range, which what it's looking like it's going to come in at. You have a strong jobs market and prices coming down. This is the new neutral rate. The neutral rate is not 2.5%. It's at least we have to accept right now. If we are not going to accept any lags, then the neutral rate's 5.5%, if not higher. And if that's the case, then some fundamental relationships have changed in the economy over the last 25 years, such that indicators that used to have meaning no longer have meaning. The curve, the 3-month to the 10-year curve inversion has a 100% track record. Now, mind you, it's a little bit early to be saying, oh, we're not going to get a recession now, but it still has a 100% track record. If we avoid a recession, if it's going to be 2-3 years down the road, that is a wrong signal. Leading economic indicators, a 100% track record when it's at these levels of preceding a recession. And if, again, that doesn't happen, then that is wrong as well, which means that perhaps some fundamental relationships have changed in the economy. And I think we can point to two that may be of interest to researchers to try to figure out, why we're getting the signals we're getting, yet still having an extremely robust economy. Imagine that you live in a particular village, and over the last 50 years, you've been attacked by a neighboring village again and again and again. Over time, you're going to build up defenses against that attack, such that when they attack, you are pretty much immune from the effects of the attack because you've built up defenses against it. In the animal kingdom, there is something referred to as the coevolution of predator and prey. Is that the predators will kill the slowest prey. The strongest will be selected to reproduce, thereby creating a stronger, let's call them gazelles, a stronger and faster group of gazelles. Well, the weaker lions will never catch those gazelles, so they'll die off. So the stronger ones are naturally selected, and they will produce a stronger herd. That's what coevolution is that as the lion gets bigger and stronger, it kills the slower and slower gazelles, which means they're selected out and only the faster gazelles reproduce, producing even faster gazelles, which produce stronger lions, which produce faster gazelles. Well, perhaps with interest rates, you've had the same thing with businesses over the years, is that businesses, 30 years ago have said these interest rate movements really bother us. And new financial products were introduced as a way to defend themselves against these attacks. Much like you would learn to defend yourself against attacks from a neighboring village, corporate America has built up defenses to defend itself against changes in interest rates. And there's so much financial sophistication now that the interest rate really has no effect, such that companies have, that even companies with floating rate debt have overlaid it with 5-year and 10-year fixed for floating interest rate swaps, such that they still have a very low fixed rate, and they're basically, both their balance sheet and income statement are immune from these rate hikes. We also have a different type of population distribution today than we did 30 years ago, with the retirees making up a large part of the population. They don't rely on income. They're not job dependent. They're spending down their capital at this point, so they're sort of immune from cycles in the economy. In a recession, their income will continue to flow because they spend a certain proportion of their portfolio, which is probably moved mostly into fixed income now. They spend a portion every single month. They're not reliant on keeping their job, so that their spending becomes more immune from changes in rates because they're retired. They probably have no debt. They own their house. They own their vehicles outright. They're not buying new furniture. They're not, borrowing against their house to install a pool. They're basically living the retired life now. Maybe it's the combination of those two things that make the interest rate less effective than what it has been in the past. And that could be why, even with an inverted yield curve, much of the economy is immune from that anyway, so the signal is meaningless. it would be like I built up my defenses so much against attacks from that neighboring village that when somebody says they're coming again, whatever. Let them come. They're never going to get past the wall. We know that. Let them throw stones at the wall. It's never going to happen. TLT had a bad week, down 1.46. SPY up 1.05. We have a negative correlation in there. And I think now that we have moved away from this era of central bank accommodation where the yields that we witnessed for the last 15 years were a function of central bank activity and not really a reflection of market activity. Since 2008, we basically had a positive correlation between bonds and equities. Now that we don't have that in place, and now that the capital market curve is more market determined than central bank determined, I think with volatility in yields dropping, we may revert back to the relationship pre-2007 between government bonds and equities, where there was a negative correlation between the two, which means a 60-40 portfolio has its own built-in hedge. Let's keep our eye on this to see if that negative correlation stays in place. I've made no changes to my TLT position. Implied volatility dropping. 13-week is at 5%. IV last 12.6%. Mortgage rates up 3 basis points. The spread between the 10-year and the 30-year has decreased by 13. Corporate spreads continue to contract. Look at this on high yield, 3.78 on high yield. Even triple C under 900 basis points now. This is interesting. This is the Corporate Bond Market Distress Index. You can get this from the New York Fed. The link is in the description box. Gives false signals a lot. This is interesting here, where one just rises. They all seem to move together. This line here is IG, investment grade. And these are percentiles. This is the 75th percentile. This is down around the 25th percentile here. What's going on with investment grade? That's interesting there. But if you want to dive into that a little bit more, you can find that at the New York Fed. I think they put it up last June. I just stumbled across it. But it's rather interesting. Let's look at our mortgage REITs. Agency up 2.28%, Annaly 1.29%. Look at ABR. Reported earnings, beat on earnings, raised their dividend, up 6.53%. They are now up 70% from that short seller report. When that came out, they sold off to mid-10s, 10.50. ABR is in the 1750 range, up about 70% from that report. Since that report, the company has denied the report, saying, well, it's just a bunch of nonsense, which I agree. They were then brought into the S&P 600, and with this earnings report, beat and raised their dividend again, 6.53%. Bad week for REITs, real estate REITs. These are mortgage REITs over here. Real estate down 1.78%. The higher for longer, I think, finally hit the sector, and I've been saying it for quite some time that we are going to be higher for longer. And since REITs, equity REITs, are very bond-like, you're going to have to start discounting those cash flows at a higher discount rate. Maybe they're finally getting it. And down 1.78% overall. PLD, Prologis, down 1.43%. But they had good earnings and good guidance. But maybe they're a little extended. DLR up 2.19%, still riding the AI wave. Since NVIDIA kicked off the AI euphoria in the market, DLR has gone from the high 90s to the low 120s. Housing, DHI kind of flat, Lennar up 0.89. Earnings from Pulte, and they were good, up 8.62%. KB Homes up 3.15. Toll Brothers 1.89. Hovnanian up 7.56. XHB up 2.38. ITB up 2.45. Look at some of the housing data. For June, house price index month over month 0.7, year over year. Year over year, 2.8%. I repeat that again, 2.8% year over year. In a year where you've seen rates go straight up, mortgage rates go straight up, the housing price index is up year over year, 2.8%, not down. Case-Shiller, month over month, up 1.5%. Year over year, we're still down 1.7%, but that's it. The expectation was to be down 2.2, down only 1.7. Mortgage apps pulled back slightly for the week ending July 21st, down 1.8%. New home sales for June down 2.5%. And pending home sales month over month are up 0.3, year over year are still down quite a bit. I think in a higher for longer rate regime, given that the vast majority of mortgages in the US are 30-year fixed, existing home sales are going to be low for some time. The inventory available on the existing home side will be kept low. It is sort of just a great place right now for the home builders. However, I'm going to give you an analogy of what the home builders are facing right now. Imagine a big blueberry patch. In the forest. You walk into the forest and you find this big wide open blueberry patch and you start picking blueberries. Well, you're competing with the bears. Where there's blueberry patches, there are black bears, and they'll sit there and they'll go through blueberries like you wouldn't believe. So every year you go in there, you're going to get a certain yield because you're competing with the black bears. And let's say the regional government decides to implement a spring bear hunt for 2 years. Well, during the summer, during late July and August, when it is blueberry season, you go into the forest and there just aren't that many black bears anymore, so your yields increase. But the spring bear hunt is only for 2 years. After that, those bears are going to be right back. So you have a temporary increase in yields that will fade away once those black bears are back. This is sort of what the U.S. housing market is like right now, is you have high mortgage rates that are keeping existing home sales from hitting the market, so that the home builders have this very high yield in the marketplace right now because they're not competing with existing home sales. That will end. Those high yields will end when mortgage rates come down. So the biggest threat for the home builders right now is rate cuts. The more rate cuts you get, the more at the margin, the more existing homes will come onto the market, because I can get out of this house and into another house and the mortgage rate is going from 3% maybe to 4.5%. I can live with that, but I'm not going to go from 3 to 7. The worst thing that can happen to the housing market right now is lower rates, because the new home builders would then have to compete with a whole bunch of pent-up supply on the existing home side. So the home builders are a great place to be right now. Their earnings are very strong. That's the high yield. Their earnings are strong because they're not competing with the black bears for the blueberries. So I think we can stay in that sector. And that sector will continue to be strong because on an earnings basis, the home builders are not overvalued on an earnings basis. But what we have to acknowledge is that the earnings are higher than they normally would be because of the lack of existing home sales. Much like your blueberry yield this summer will be much higher than it would normally be because you're not competing with the black bears. But once the spring bear hunt is over, your yields are going to go right back down to normal yields because you will be competing with them now. It's a busy screen, I know, but let's just go through it panel by panel. The very top chart here is the dollar index. Look at that. Let's just go through some of the data that came out in the US last week. Consumer sentiment came in at 71.6 on Friday. The expectation was 72.6, so it appeared to come in light, but the previous reading was 64.4. So that was a significant increase in consumer confidence. Consumer sentiment. Consumer confidence came in earlier in the week for July, came in at 117. FOMC did raise 25 basis points. Durable goods for June up 4.7%. The expectation was 1%. That's not just a beat, that is out of the park. Second quarter GDP, our advanced number, 2.4. Now mind you, it's our first look. We get 3 looks at it, right? 2.4. The estimate was for 1.8, which is trend. It's considered trend or accepted as the trend growth rate in the U.S. at 2.4. Again, that's not just a beat, that's out of the park. PCE coming down month over month, 0.2%. The ECI coming down 1% from 1.2% in Q1 to 1% in Q2. Incomes up 0.3%. This is a real basis. Spending up 0.5%. So incomes went up 0.3%, but spending went up by more. So the question is, was it negative savings or positive debt? Were consumers using debt to make the difference, or were they spending down savings? Well, retirees dissave, right? So being that there is it's the largest cohort of retirees as a proportion of the population ever in the U.S. So if you look at all the retirees and you look at the proportion they make up of the population, it's never been larger. So it stands to reason with retirees dissaving, because that is what you do in retirement, is you draw down your retirement savings, you dissave, that you could have incomes of 0.3 and spending of 0.5 with no real reliance on debt. Anyways, the US dollar, the dollar index was very strong. Let's move on to the Canadian. Look at their GDP, the preliminary for June, negative 0.2%, negative growth for GDP for May month over month, 0.3, and now we're sitting at a negative number. Last week, in my portfolio, I typically have Canadian dollars and US dollars. I sold all my Canadian dollars and bought US dollars with them. Not a currency trade, a currency conversion. I converted them to US dollars. So with IB, whenever you make a currency trade, you have a choice of whether it's a currency trade and it opens a position, or whether it's a conversion and it doesn't open a position, it just changes the quantity of the types of currencies you have in your portfolio. This was a currency conversion. I have already announced that I am leaving Canada. Part of my preparations to leave is that my Canadian dollars are worthless wherever I'm going. And if I'm going to Costa Rica or I'm going to Dubai, US dollars are a currency in both those locations. So I can use US dollars, but I can't use Canadian. So, step one is find a nice rate and convert it and buy your US dollars. And I think the Canadian dollar is pretty much at the highest strength it'll be for a while. So I may as well convert there. So it wasn't that I saw an opportunity. It was just, look, I got to convert to US anyways, so why not take this opportunity? So I sold my Canadian, I bought US. I did it all at 1.3193, and I put it in T-bills, 6-month T-bills that mature January 13th, 2024. I got a 5.51% yield on that. The yen probably was the interesting story for the week. Nothing changed, but there was some wording change, and it could be significant. I don't know. I don't agree with the analysts who suggested that this is the beginning of a strengthening for the yen, and that it has some implications for bond yields in other parts of the world. I just don't agree with it. The yen as a funding currency will continue to be a funding currency in a carry trade because money market yields haven't gone anywhere. And you'll be borrowing your yen at the short end of the curve using money market yields. The wording that the central bank chose dealt with yield curve control primarily at the 10-year. So let's see what they did, and I'll sort of say why I think a weakening of the yen, or at least not a strengthening of the yen, seemed to be the most appropriate outcome, whereas market watchers of the yen were thinking it should strengthen. There was a wording change, greater flexibility, to introduce greater flexibility to yield curve control. And the 10-year was trading, or was pegged to trade in a range of negative 0.5 to positive 0.5%. And the BOJ, Bank of Japan, said, we are going to treat these bounds as references and not rigid limits. And announced that it will step in and buy 10-year bonds at a yield of 1%. So the yield on the 10-year after the announcement rose to almost 0.6%, which is price dropping. In other words, the Bank of Japan is saying, we'll buy the 10-year, but not at this price. The price would have to drop a little bit more before we buy it, and that would be at a yield of 1%. And the thinking is, well, a 1% yield is far more attractive than a 0.5% yield. That will draw money into the 10-year. I don't see that. I see it as the price of the 10-year is dropping. Why would I want to get into something where the price is dropping, knowing that in time they'll relax it to 1.5 or 2, that the price will continue to drop? Why would I get into something, yeah, the yield is rising, it's more attractive than 0.5, but it's still not that attractive, and we're at the beginning of something in which the price is dropping. To me, it doesn't make a lot of sense. You are not affecting the money market rates, so I don't see how that's going to change the value of the yen itself. You are allowing the yield to increase to 1%. At the margin, is there a Japanese investor that says, well, I may as well buy my local 10-year bond instead of buying an international 10-year bond? At the margin, is there an investor that will say that? Perhaps. But I don't know that it's going to cause a wholesale change in the yields in bonds in other countries because of that possibility. It didn't seem logical to say, well, that will begin the strengthening of the yen. If there is an unwinding of the carry trade, then yes, that can strengthen the yen. But I'm just not seeing it with this move. This just doesn't seem to be the right move. When the BOJ starts raising interest rates, there's the beginning of the unwinding of the carry trade, or at least at the margin, some movement on the carry trade, which would cause some dislocations somewhere. But I don't think this. So overall, U.S. strong data versus the euro, and Canada has weak data versus the U.S. So being that the U.S. has stronger data than the euro, I think that speaks for the U.S. strengthening, because what's your alternative? The other big currency is the euro. And I think Canada has weak data versus the U.S., which means that the Canadian dollar should weaken against the U.S. dollar. JPY, still no yield. It will still be a funding currency. Copper had a great week last week, up 3% on the week. Freeport up 7.43%. COPX up 5.16%. For Freeport, I am selling 30 Delta puts every month. I have an allocation to Freeport, which I'm happy about. I'll take more, and I will get it by selling 30 Delta puts. At some point, there'll be pullbacks. I'll get them. Freeport is also a good target for an allocation factory because it does have weekly options, liquid weekly options, which makes it more efficient and more profitable for an allocation factory. I will put that in the applied series in portfolio construction in a couple of weeks. We'll do an allocation factory on FCX. Or we'll look at building one and what that looks like. From Freeport's quarterly earnings, their presentation gave us sensitivities to changing prices. Here is copper, the important ones here. Here is copper and here's currencies. So plus or minus 10 cents ends up being 425 million on EBITDA. If copper goes up 10 cents, an extra 425. Well, it's showing up in the price of Freeport. Copper is up 3%, which is almost 10 cents over the week. So EBITDA has just increased for FCX by 425. Operating cash flows another 335 million. And I did show you the strengthening of the US dollar. Here's currencies, plus 10%, another 240 million. It didn't increase 10%. It increased, I think, 1.5%. But any increase is beneficial for Freeport, an increase in both EBITDA and in operating cash flow. The reason is all of their output is sold in US, but their costs are in local currencies. Other than, of course, in the US, their costs are in US. But in Indonesia and South America, as the US dollar gets stronger, they could buy more of the local currency. So they have a currency gain in both those regions. Rio reported last week, not so good. They're much more exposed to iron ore, and that is sort of holding them back. In terms of copper, Rio does produce copper. FCX really only produces copper, and well, I shouldn't say they do that. They have two mines that are dedicated to molybdenum, but a lot of their other product that they produce are byproducts of producing copper. So as far as a pure play, FCX is as close as you can get to that. Excluding non-controlling interests, FCX sales projected for 2023, 2.7 billion pounds. Rio, 1.2 to 1.3 billion pounds, but that's their production. I couldn't find what their forecasted sales of copper would be. So they're producing about half the amount of copper as Freeport is, but they're exposed to the big one that they're exposed to is iron ore. If we look at their sales of copper versus all of their sales, 9.8 billion is revenue. 1.1 of that comes, or sorry, EBITDA. 9.8 billion is company EBITDA. 1.1 was from copper. If we look at underlying earnings, 5.8 billion, only 0.2 came from copper. For costs, Freeport has using the byproduct method, cost per pound of copper of 147. Rio 180. But I can't find the information of whether that is the co-product method or the byproduct method. Byproduct means, like for Freeport, a byproduct means I'm in this mine to get copper, but in the process of getting copper, these other metals show up. So I'll sell those other metals, which will lower my unit cost of copper. So that's why it's called byproduct. It's an offset. If you have just the co-product method, you would calculate the cost of each metal that you're producing. Then the cost of copper is much higher for Freeport if we think about it as being in several different markets. I can't tell for Rio whether this 180 is byproduct or co-product. If it is co-product, that is a very low price for copper. That is much lower than what FCX on a co-product basis, I think, is like $1 higher than that, somewhere around $2.50 a pound. If this is the byproduct method, then Freeport definitely has the advantage there. Either way, Rio doesn't have a big enough copper profile to really affect its earnings and its EBIT based on all the other things that it's producing, that if you're trying to get as close to a copper play as you can, COPEX or FCX seems to be the better place to be, with FCX as a function of the copper price, FCX seeming to be the better place to be. GDP for Q2 came in at 2.4%. That seems like a beautiful number, right? But we do have a little problem with it. Let's decompose C plus I plus G plus X minus M. Consumer 1.12. Well, what do we know about consumption out of GDP when we talk about the how much the consumer is of GDP? We normally say 66 to 70% of GDP. While 1.12 is only 46% of GDP. The consumer is only 46% of GDP. Typically, you're looking at around 70%, under 50%. I, 0.97, that's strong. G, 0.45, and the trade balance, negative 0.12. What did the consumer do? 0.16 from goods, 0.95 from services, and within goods, 0.03 from durables, 0.13 from non-durables. For investment, fixed investment added 0.83. Non-residential was the winner there, 0.99. Residential, negative 0.16. Inventories, very little, 0.14. For government spending, state and local did all the heavy lifting, 0.39. Fed was 0.06. Defense up, non-defense down. And for the trade balance, exports down, imports up. And with imports, both goods and services. And exports, it was mostly goods, still positive on some services. We don't have a number for gross national income. The relationship between GDP and GNI is as follows. Take GDP and add receipts from the rest of the world. That is a U.S. resident working somewhere sending their money back to the U.S. And then payments to the rest of the world, that's a foreigner in the U.S. sending their money back to their country. So money coming in from another country, money leaving, net that out. Take out depreciation, you'll get gross national income. And this is unknown at this point in time. The relationship between fixed investment and depreciation has an effect on GNI. If you have a period where you have no investment at all, you're still going to have depreciation, which means GNI will be much lower than GDP. As you increase the amount of investment, let's say that you exactly offset depreciation, then your GDP should equal your GNI. Q1, if you took the average GDP plus GNI, or you weighted them, it's just, taking the average is the same as weighting them by 0.5 each. You get 1.01. You would recognize that as being lower than what the reading we got for Q1 real GDP is, and that's because GNI was negative, gross national income was negative. We don't have a number for GNI this quarter, so you get it later on. We just don't have it with the advanced number. But in this report, if anything is alarming, it is this over here, that the consumer is only 46% of GDP. The U.S. economy is set up in such a way that the consumer really needs to be the bigger part of the economy. This is not an emerging economy where investment can lead for a decade or a decade and a half. It can have spurts of investment, but it can't lead. It is too advanced and too big to be doing that. So you do need the consumer to come along, and sitting at 46% of GDP, if you had to pick apart something on this one, that is the big one. I'm surprised it didn't get more discussion than the discussion that happened. It was just, yay, 2.4, and off to the races we went. Later that day, this was Thursday, later in the day, the market sold off. The market was up strong in the morning. And the IMF had already, we'll see that on the next screen, had raised its forecasts for global growth. So it was on that Thursday that I thought, you know what, this short position it's just not working. What am I doing? At some point I got to give this up. The market is just not agreeing with me. I still think that underlying everything I'm going to be right, but you just can't argue with this market. So I thought I'd give it to the end of the week, and if things just weren't working out, I was going to shut down every short position I had. By the end of Thursday, the market has sold off, and I just took that. I took that opportunity to shut down the short position. I closed my puts at about $1 loss on 60, and every buck is worth 50 points, right? It's worth $50. So little over $3,000 loss on that. I shut it down. I have no short position on the market anymore. I can't really justify it any longer. Almost everybody who was a bear seems to have capitulated and given up. And it has been a wrong call since the beginning of March. The multiple just kept expanding and expanding, and you keep thinking, well, you know, the data's weak. And even looking at this GDP report, you look at the consumer at 46%, under 50% of GDP, you think, but this, you know, this is an issue. And early Thursday morning, the market just didn't care. It just didn't care. Well, how do you rationalize against a market that doesn't want to be rational, or that doesn't respond to traditional macro signals? This should have been an issue. This 46%, it should have been an issue, saying, well, that's not good, but it wasn't. Not until later in the day. When I saw the sell-off later in the day, I thought, okay, you know what? Let's just take it. I'm done. What I did not want to see on Friday was the market down 200 points. And I had that feeling going into the evening that once I closed my position, I thought, you know what's going to happen? Tomorrow we'll be down 200 points. But we weren't. So I felt good about Friday. The market was up strong. My long positions were doing well. I didn't have the short position holding me down. And it was like, thank you, at least for rallying, because if it had sold off 200 points the next day, I don't know what I would have done. I would have been really angry with myself. Last week, the IMF upgraded global GDP growth. The July forecast for 2023 for the world is now 3%, up 0.2 from where they thought it would be back in April, from 2.8 up to 3. For the advanced economies for 2023, 1.5, up 0.2 here, and for emerging and developing economies for 2023, up 0.1, only to give it back next year. The next chart here is the dark blue line is actual inflation, and all those other lines are forecasts at different points in time. Which, when I saw it, I thought, well, you know, this is not making your point. That if we're going to rely on your projections, this is not making your point at all. In April 2021, you thought it would do this, and you were wrong. It did this. So you had another chance in October, and you said, well, it'll do this, and you were wrong. It did this. And then in April 22, you said, oh, okay, it'll do this, and you were wrong. It did this. And we can see the projections now. It's been coming down, and this was October. The light pink line here was April, and this is July. They're forecasting it to come down slower and slower. Well, even if you look at the Fed's summary of economic projections and the path of real GDP and unemployment and inflation and they release it every second meeting, wrong, 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 wrong. These are very difficult things to forecast in complex adaptive systems. Systems that are characterized by two big things, non-linearities and a high degree of randomness. That there is this human desire to attribute structure to things so that we can understand it. But I think it's attributing structure to a lot of randomness. So it could continue this way, or it could do a late 70s thing and turn around. I don't know that I would rely too heavily on forecasts. If you take all the forecasters who have been talking about inflation, all the forecasters from, it's going to go all the way down to 0 to, no, it's going to be with us for a very long time. There's a whole distribution. And if you have a random system, it was going to be somebody somewhere that was going to be right, but not because they were great at forecasting. It's just that inflation had to be something, and somebody somewhere was going to be right purely by coincidence and purely by randomness. The ability to predict these things correctly every single time, I don't think exists. Look what's going on. These are smart people doing this. They're not uneducated people that are doing that. They're quite sophisticated, and sometimes with some very, very advanced modeling that has previously shown itself to fit the data quite well, and you have this sort of outcome going on. Okay, let's look at SPY here. As I've said previously, I have closed my short positions. Forward 4-quarter operating earnings 227.33. SPX closed at 45.81. That's 20.15 times forward earnings, or to use the forecast for as reported, 22 times the forward earnings. This market is not priced for a soft landing. This market is priced with the absolute belief that the economy is going to expand from here. There is no landing. There is no landing. We are going from low growth to immediately high growth. So it's not pricing in the hope that tomorrow is going to be better. It is pricing in the absolute belief that tomorrow will be better. So you've gone from hope to belief. 4.48% below all-time highs right now, up almost 20% year to date. I just never would have, if somebody would have said, oh, by end of July we're going to be up, the market will be up 20 points. If somebody had said that on January 1st, I would have said, yeah, okay, Tom Lee, thank you. And here we are. Here we are. Unbelievable. 4.48% below all-time highs. I just never thought it. If, when money was free, we thought 4,800 was the bubble of all bubbles, what is this? What is this? I don't know. Anyways, the economic data appears to support it. Earnings, well, they're not, you're not getting incredible growth in earnings, but you're not getting incredible deterioration in earnings either. They're kind of coming in there. These are the multiples we have. I'm not alone in capitulating here. The Fed staff economists have taken a recession later this year off the table as well. They've capitulated. Mike Wilson, who has been on the short call since the beginning of the year, he is in this past week capitulated as well. Did a mea culpa, said I was wrong. And so was I. I was wrong too. I just didn't anticipate this kind of strength, this kind of belief. Just didn't see it. Now, I think perhaps that there was some bias in my beliefs because I had a short position and I believed in my short position. I think it made me believe in my short position more than what was justified, and I probably wasn't paying attention close enough. I don't know. You try to look for some kind of reason after the fact of why, not why you were wrong, but why you were so wrong. Like, it's okay to be wrong. I mean, I'm wrong, a number of times a year in my pick. Sometimes I'll buy something and it just doesn't work out, or I'll sell something and it just doesn't work out. But, you're somewhat wrong. On this one, I have been absolutely wrong. So enough is enough. I give up. So I'm going to just focus on, those areas of the market that I think have good long-term value, like copper, like a short US dollar, a short Canadian dollar against the US. GM, I think, is going to offer a nice opportunity over the next month. I think the fear of a strike will start to appear in the stock, and if it does, if it gets below 35, I'll step in again. I think the home builders, as long as rates stay at these levels, I think the home builders probably have more upside to go because they're not overvalued. And I'll continue to look for stuff like that. The mortgage REITs, I'm going to stay in the mortgage REITs as well. ABR has just been absolutely great. FCX has been great. I've had a good time with the home builders, although I did get out a little too early, I think. But I'm sure I'll have some opportunity to get back in. Maybe I'll start selling puts on them again. This is another thing that's sort of interesting here. Implied volatility last was 10.8. Implied volatility has been running below historical volatility for some time now. The options market is pricing in a volatility to the options that is lower than the actual volatility of the underlying. That's how much they don't want puts. That's how much the market says, no, thank you. We don't want these puts at all. We have no fear. You can't make them cheap enough for us to buy them. We don't want them. You have IV lower than the actual volatility of the underlying. Usually, IV overstates actual volatility, which makes selling premium a higher probability event than the probabilities would say, because IV usually overstates actual volatility, but not now. 13-week volatility sitting at the 8th percentile. So there we are. There is what you're paying for the market, whether you're looking at as reported or operating earnings on a forecasted basis. So far, with half the companies reporting, year over year, earnings are down 6 point something percent. Let me say that again. Earnings are down 6 point something percent, and we are now at 4.48% below all-time highs. Year over year, we are up. Year over year, the market is higher, and earnings are down some 6.5% year over year. Earnings are down and we are higher. Let that sink in. The consumer is 46% of GDP, not 70% of GDP. Let that sink in. 525 basis points of rate hikes, and we are here with these multiples, with these relationships. Let that sink in. It is hard. It is hard for me to say these things and not want to put a short position back on by saying, no, I'm right. I'm going to be right. However, you can't stand in the way of this. You know, one thing one rule that I've repeated many times over the years is never short momentum. And I think we've gone from a fundamental market to a behavioral market in the last couple of months. And this is momentum. The other thing that I've been hearing a lot is AI. And that is a future that you can't argue against, because it is whatever you can imagine it to be. And this was 1999.com. You can't even begin to appreciate how large the numerator will be in your discounted cash flow. It's going to be off the charts. This is a new economy. Nothing applies. We need new rules, new metrics, new ways of measuring things, and everyone bought into it, and up and up and up and up and up we went. It was wicked momentum. You could not short that market, even though everyone agreed it was way overvalued. You would get killed shorting it, and I think that's where we are here. And I think going forward, unless something big breaks, if nothing breaks, something will break. Something will, because of the lag effect. Those rates will continue. I'm going to show you something in a minute when we get to the notable headlines where we're starting to see something. Something big will break, but until it does, momentum is your friend until the end. Another big week for earnings. 168 issues reporting between July 31st, Monday, July 31st, and August the 4th. Remember, next week is big on labor, big on earnings. 168 issues. Here is the list. The spreadsheet is the link is in the description box. I don't really like looking at it in terms of Monday, Tuesday, Wednesday. I prefer looking at it in terms of the sector that's reporting. So you can just cut and paste that section into a new sheet, and just sort based on the sector. And this way here, those sectors that you're interested in, you could just go to those sectors. So there's your consumer discretionary. There's an interesting one. There's Borg Warner. Consumer staples, energy, and there's Oxy. Any weakness on that one, I'm going to take advantage of. If they have weakness on the nat gas side, and they miss and they sell off 57, if I see a 50, low 58s, 57s, maybe even a 56, I will move in on that one very quickly. I will sell the 57.50s and the $60 puts. Yes, if they're down to 57 and 56, I will sell the $60 puts on that. Some financials, lots of healthcare. I've never ever done anything in the healthcare space. I don't understand it. I mean, I could spend the time and get to know it and understand it, but I just never bothered to make that investment of time. Industrials, there's CAT. There, Deere, I think, is next week. IT, the big one, where is Apple? Apple is reporting. There it is there. That's sort of the big one this week. Materials, real estate, and utilities. Utilities fairly boring overall. I don't know that I don't know that I've ever bought a utility. I bought the utility sector, but I don't know that I've ever actually bought the utility. Simon Property, as far as retail is concerned, that'll be interesting. Same with Realty Income. What else do you have in here? Boston Properties. Let's see how office REITs are doing. And that is earnings. We got a couple more screens to get through here. Not market related, but earlier in the week there was a heavy rainstorm here, and after it was over I walked out of the front door and I looked, and look at that, a double rainbow in the sky. Thought you might like to see that. Some notable headlines that I saw. Number one, big bankruptcies rise at the fastest pace this year. This was from the Dow Jones Newswire. Companies entering Chapter 11 with more than 100 million in debt or assets, or those with national prominence, 82, which seemed like a large number to me. In 2022, by the same time this year, it was 29, and in 2021 it was 43. We're at 82. Healthcare has the most, more than 20%. Retail came in second. And I combine that with this chart that I found. I forget where I found it from. What is this? S Cross Asset Research, Quant Research. Oh, from FactSet. Okay. This is really interesting. For the largest U.S. companies, rising interest rates are not a problem. The same cannot be said for the smallest. And this is the interest coverage ratio on the vertical. And the red line here is the top 10 of the S&P 1500, which would be in the S&P 500, the top 150 in the S&P 500. This is their interest coverage ratio. Look at that, they're somewhere up around 13, 14 times. Whereas the black line here is the Russell 2000. You're sitting around 2 to 3 times an interest coverage ratio. That's starting to get really tight, 2 to 3 times interest coverage ratio. The chart down here, cash piles remain healthy among large caps, but are nearing historical lows in mid caps and small caps. So the top 10% is way up here, the middle 40% way down here. Look at that in terms of cash as a percentage of total assets. If you pull this back here for the large ones, you're sitting around 30 to 35%, and for the middle, this is the middle 40 down here, somewhere around 20%. The top one up here, this is the largest 10% of U.S. companies have barely seen their interest rates rise. And this is what I've been saying, is the level of financial sophistication allows some companies to completely immunize their balance sheet and their cash flows with different derivative products. The largest 10% have barely seen their interest rates rise. Here they are here. Here's the effective interest rate. sitting around 3%, but you can see going back, here's 14, 15, June, this is in June, 2014, 15, 16, 17, 18, 19, you know, basically almost unchanged, have barely seen their rates move. This is the bottom 40%. Look at the increase here. They were sitting around, you know, 4.5%, sitting up here now somewhere around 6%. And I find this one here really interesting. Those with the most cash hold very little of the overall debt. So how we read this is this. This is the S&P 1500 ranked by cash on the balance sheet. So if we take, this is the amount of cash right here. So if we just go up to here, from the 200 up to here, we're somewhere at that point at 200 million in cash. Companies with 200 million or less in cash account for almost 60% of all the debt. That once you get up to about, let's just go across from the 80% here and come down here, that if you got more than $500 million on your balance sheet or higher, this is at the 80th percentile, there's 100. That's only 20% of the debt, because this is cumulative, right? So 500 million or less, companies with 500 million or less of cash on their balance sheets account for 80% of the debt. Those with 500 million or more only account for 20% of the total debt outstanding. So it is the smaller companies that have seen their interest rates increase, smaller companies which have a lower interest rate coverage ratio, and it is the companies with less cash on their balance sheet that hold the majority of the debt. 500 million or less own 80% of all the outstanding debt, and I think the corporate debt outstanding is somewhere around 13 trillion. So think about that. 80% of that is concentrated in companies with very low interest rate coverage ratios, very high effective interest rate, and represent the largest proportion in terms of the amount of debt, those with fewer companies. You start looking at these little things, you know, we're at 82 versus 29 and 43. And you combine it with this and you start thinking about where we are in terms of valuation, how low the OAS are right now in both high yield and triple C, that it just doesn't seem to make sense. Something seems to be off somewhere. Okay, two separate stories I saw last week, but that were related. One was on TD's site, titled Mind the Gap. So if you Google TD Mind the Gap, you'll get that story. And it had these charts, and it was looking at GDP per capita. First one, let's deal with this. Canadian population growth versus the rest of the world. Here's Canada over here. Here's population growth. This is 2011 to 2019 average. The dark green bar is 20 to 22 average. Notice that it is higher than previous, which is a different trend than you're seeing for all the other countries. That from 2020 onwards, Canada's population growth was higher than it was in the previous decade. No other country has that, at least no other country on here. Look at Japan. This is why they're having such a hard time getting inflation, is because they have population decline, not population increase, but population decline. It's hard when you have fewer and fewer people to keep getting GDP higher and higher, and to get inflation up when you have fewer and fewer people. You have to measure things differently. Anyways, Canada's population growth, not only has it the only one here that of the G7 that is increasing in the 2020s versus the decade before, but look where it stands versus every other country in terms of its population growth. The next closest one, let's say for 2020 onwards, is the U.S., which is a little less than half the population growth. Now this is where it gets interesting. This is real GDP per capita. This is 1980. Here is Canada, real GDP per capita. Here is 2020. Here is 2022. Now it has been increasing, kind of misleading in a sense because it's taking large gaps, right? 1980, 2000, 2022. We don't have intervening years in here to see what the trend is, so it kind of looks like, well, we're still increasing. But look what's going on now. Versus the United States versus advanced economies. We were kind of on par with the US and above advanced economies. Then kind of on par with advanced economies but below the US. Now Canada is below all three. And this came from another story talking about declining per capita GDP in Canada. I think the title was the downside of population growth, or sorry, the downside of immigration, I think it was called. So the darker line up here is US per capita GDP. And down here is Canadian per capita GDP, and it tracked fairly closely with each other. But look what's going on here. You have low population growth in the US. Now the dark bar here is from 2020 onwards. Here's the 2020 cutoff. Very low population growth, GDP per capita going straight up. Very high population growth, look what's going on with GDP per capita. It is starting to trend downwards because the population growth, you have a level of growth without the corresponding growth in GDP means you have a lower level of GDP per person, such that the national, if we accept GDP, the identity equals GNI, GDP equals GNI, gross national income, that the average income per person, what this is saying is the average income per person is decreasing. This is negative. That's sort of a negative for Canada as a whole. So that's, I thought that was rather interesting. And that is the end of this one.